next video. Okay, let's see. This is exam 2 material, and so yes, puppy. I assume that you have already watched the video on uncertainty. Yeah. That would be the first new one for exam 2. The last one for exam 1 would have been the Davidson capital market, which I'm going to kind of review here again. But where that left off, the Davidson capital market one was that the way Davidson had it set up, the economy was going to come to something that's very unrealistic, and that is a stationary state. That at some point, firms were going to invest to the point where they've got as much physical capital as they wanted, they're just going to stop. So, either the economy had shrunk down and kept on going like this, or it had risen and kept on going like that. One way or the other, stationary state. Now, we all know that doesn't make sense. That in reality, there is a business cycle. And the very first time I taught this class with that book, I thought that, I know he doesn't believe that. That doesn't make sense. And so I tried to figure out, how can I adjust this in the context of all the other post-Keynesian stuff to make sense of it? And I done come up with this. Actually, it's a paper that I published, but this is a presentation I did on it. And the reason I want to do it on the PowerPoint is you'll be able to see the graphs so much more clearly. They're going to be right on top of each other. If somebody wants this PowerPoint, email me. I never remember to give these things out because I never think of the PowerPoints as being very useful. But if you want it, sure, absolutely. Let me know and I'll email it to the whole class. So what I'm about to do, well, I'll show you. Hang on, dog. All right, this is me setting up the paper. This is actually the presentation I actually did, so this is me setting up the paper. Let's see here, and then the business cycle. Okay, now you're familiar with this. And it's putting the the capital market diagram and the business cycle back into the context of the ZD diagram. This is straight from Paul Davidson's book where he developed that model. I just copied what he had there. So where we want to be is right here, of course, at full employment. However, whenever the curve shifts down for whatever reason, that's going to leave us short of full employment. And of course, as you and I know, the reason for it to shift down is for a fall in investment, which is what we're about to get to here. Okay, so here's the Davidson capital market. I know you've already done this on the last exam, but let's go back over it again. That's not a terrible thing, is it? And here, first of all, the demand for capital. As you may recall, D sub K is the quantity of capital demanded, so that's how many new factories or restaurants or whatever that firms want. P sub K is the cost of a factory or a restaurant. That's how much it costs to build it. So that's going to enter in negatively. The higher the cost, and the less likely that, or the lower quantity of restaurants and factories that firms will want to purchase or build. I is a rate of discount. It's a little bit like the interest rate, but he describes it this way. That how much people discount future earnings. That if I said to you, do you want $5 today or $5 a week from now? You're going to say today, because I'd rather have it right now. If I said, do you want $5 today or $100 a week from now? You'd say, I want the $100 a week from now. Somewhere in there, you're going to get to where you're like, ooh, I don't know. That's kind of tough. $5 a day or $5.57 a week from now, I don't know. And that's when we've determined the rate at which you discount future money. To you, $5.57 a week from now is the equivalent of $5 a day. Well, the higher the rate at which you discount future earnings, the less likely you are to build a factory. Because you're like, I want the money now. I want to be able to spend this income now. I don't want to build a factory and then earn income slowly over time. Future income means nothing to me. That would be like if I said, do you want $5 today or $100 for a week from now? And you said, oh, $5 today. Because that would be an incredibly high rate of discount of future income. So the higher the rate of discount of future income, the less likely you are to invest. It's not going to end up being a big important variable here anyway, because really it's going to be sort of the inverse of this right here, which is the expected growth in the, and this is the way Davidson works it, the expected growth in the demand for the products produced by the capital in question. In other words, if you're building a new restaurant, this is how much you expect people in the future to want to go to your restaurant. All right, well, what's the demand for restaurant food in the future? If you're building a shoe factory, then that is, what do I expect the demand, and it's expected, demand in the future for shoes to be like, all right? So it's whatever your factory is going to make. What's the demand for that? Because you don't want to sell the factory, you want to sell the stuff the factory's making. And then last, and this is unusual that he bothered to include this because most models don't, he said, well, we're also going to get financing. All right, and this is going to end up being the next topic we cover in great detail is going to be financial sector. He said, just because you've got this great idea, that means nothing. Until you are able to convince somebody to loan you the money, it ain't happening. So your ability to receive financing is also going to be a factor here. So the higher the price of the restaurant, the less likely you are to build it. The greater your rate of discount, the less likely you are to build it. The more you think people are going to want to go to restaurants, the more likely you are to build it. And the more able you are to get financing, the more likely you are to build it. All right, so there was the demand. Now, there's the demand curve, right? We've got, do I have that in the next slide? No. Notice here we have the price on the vertical axis, which means the slope of the line is being determined by that price right there. As price goes up, the quantity demanded goes down. All three of these are still on there, but they're going to cause shifts. And in fact, that's exactly what's going to happen when we get a little further into this, is the important thing is going to be the shifts that take place in this demand curve are going to cause the business cycle. All right, so there is the higher the price of a unit of capital, the higher the price of building a restaurant, the smaller the quantity of restaurants entrepreneurs want to build. This is the existing number of restaurants right now. Case of one is the existing stock of capital, the existing number of restaurants, right? Then, see that? Isn't that awesome? Watch. Magic. Ding. There's the demand curve on top. And that gives you what Davidson calls the spot price or the demand price. He also calls it the demand price of capital. Now, I got to tell you, when I was first reading this book, Davidson is very much a follower of Keynes, and Keynes was a follower of Marshall. And Marshall tended to talk in terms of supply price and demand price rather than quantity demanded and quantity supplied. Let's say we've got a situation, shucks, I wish I had my board over here. Let me draw it for you real quick. Let's just shift the camera over here. Sorry, doggy. Let's shift the camera back to this for a moment. That's yeah, that's all our laundry there. I'm in charge of doing the laundry. Melanie is in charge of folding. So won't she be excited when she gets home? All right, let me turn this camera. This is around here. Okay, this is what I'm talking about here. Oh, I'd already put the pens away too because I wasn't planning on using this. I didn't think about it. But check this out. I want to talk to you about the supply price and the demand price. And my point here is it took me a while to figure out what in the heck Davidson was talking about, because this is not the way we talk nowadays in economics, but it makes perfect sense, and boy does it work better for what he's setting out to do. So we have a simple supply and demand diagram, but we're not in equilibrium, all right? Let's say we're not in equilibrium. Then, let's see here. What we usually do is this. When we talk about a situation that's not equilibrium, we say, oh, look, at that price, the quantity demanded is less than the quantity supplied. As you can see here, the quantity demanded, of course, comes off the demand curve, and the quantity supplied comes off the supply curve. At P sub 0, that's not equilibrium. I'm trying to stay in front of that little glare there. At P sub 0, that's not equilibrium because the quantity demanded is less than the quantity supplied, so the price will fall, right? This is the way Alfred Marshall talks. And Alfred Marshall basically invented microeconomics, and so it's not like he's just some joker wandered in off the street and started talking about stuff. He thought this way. He thought in terms of supply price and demand price. It's the same sort of thing, but check this out. All right. he says, aha, that quantity is not an equilibrium quantity because the supply price is P sub 0, but the demand price is P sub 1. The price that firms would have to be able to get for make them willing to produce Q sub 0. Let me say that again, sorry. The price that firms would have to receive to make them willing to produce Q sub 0 is P sub 0. But for the consumers to be willing to purchase Q sub 0, the price has got to be P sub 1. So this is the demand price, and that's the supply price. The price that suppliers would have to be able to get in order to make them willing to produce that quantity versus the price that consumers would have to be able to pay in order for them to be willing to consume that quantity. We're going to be talking this way, all right, in terms of supply price and demand price, and it really works for what we're about to do over there on the TV screen, because what we're going to end up with is a situation where entrepreneurs, sorry, 4 years of French, they're going to have their demand price, all right, but then we'll call it construction industry or whatever. We're going to have a supply price. This is the price that the entrepreneurs are willing to pay for the restaurant. This is the price they actually have to pay to get a restaurant built. Aha! Whenever this exceeds this, investment boom. My gosh, it only cost me $1 million to build the restaurant. Heck, I would have paid $2 million, all right? So I'm going to build a restaurant. Whereas when this is higher than this, we have a glut. That the amount it costs to buy, the amount it costs to build a new restaurant is $3 million. Heck, I wouldn't pay $1 million for it. So we got too many restaurants and the economy will shrink as firms don't invest. So we're going to be talking over here in terms of supply price and demand price. Demand price is the price that entrepreneurs are willing to pay. Supply price is the price they actually have to pay the producers of capital in order to get those producers to actually make the capital in the quantity that they want. And it's a really, as I said, it took me a while to get used to it because I was raised with this method over here, and I knew about this, but I hadn't thought about it in years. And so once I got used to it, though, I really actually preferred this, at least in this context, at least in the context of talking about investment. So, what we've got so far is this is the demand price. It is what, oh, I got my camera right in front of my monitor so I can't see what I'm pointing at. This is the price that entrepreneurs are willing to pay for a new unit of capital. Here is the existing supply. Here is the demand curve, which is derived from those right there, all right? Once we had taken these factors into consideration, it told us that the demand curve should be right there, all right? So, what this is saying is that these entrepreneurs are looking out at this sea of restaurants, and they're saying, boy, if I could buy one of those restaurants, I'd be willing to pay P sub S, all right? And now the question is going to be, what do they actually have to pay? Now, not only are these budding entrepreneurs able to purchase an existing restaurant, they can build a new one, right? You can either buy an existing one, buy somebody out, or buy a share of stock, which is buying a share in that industry, or they can build a brand new restaurant. And that's what this curve is right here. This is the building of brand new restaurants, okay? That, of course, we start at K sub 1 because we've already got that many, so we're adding to them. And it's upwardly sloped because we're operating on the assumption that the busier the construction industry is, the higher the prices are going to be of construction. You know, way back in here, oh, and by the way, I'm sorry, PM. PM is the least they would accept. This is the cheapest you can possibly make a restaurant for, all right? Or a factory or whatever we're talking about here. And so it's not going to be, it's not going to come out of the origin. I mean, there's not going to be, oh, I can build a restaurant for $0. No, there's some minimum price. Again, it's very abstract. We can't really say the price of a unit of capital, can we? Because there's so many different kinds of units of capital. But Sticking with the restaurant example, this is the cheapest we could build a restaurant, some generic restaurant, and then the busier the construction companies are building new restaurants, which is what this will be over here. There'll be shortages in supplies, there'll be shortages of workers, they'll be less inclined to give you a good price. When you call them in and they write up their plans and so forth, and they don't have to be real competitive with their bid when they know you don't have a lot of choices. So the busier the construction industry is, the higher the price of a new unit of capital goes, because you can see the price going up and up. And by the way, the lowercase s sub k is the new construction. The uppercase s sub k is what's already built. And notice it goes vertical here. Theoretically, there's only so many restaurants we can build, all right? Given our current amount of supplies and construction equipment and skilled workers, there's only so many we can build in a given time period, so it goes vertical at some point. Okay. Now, so there's two supply curves, right? There's the supply curve for where we are right now. That's how many exist. And then here's adding new restaurants over here. There's also two demand curves. Here's the demand curve that we already talked about. But you have to bear in mind, I'm sorry, look, I got a little bit off on my second curve there. You can see it move just a tad there. My apologies. But this second curve with the lowercase d is merely for replacing worn out capital. Not only does TCU build brand new performance halls, but they also go in and repair the dorms and replace the computers. All right, I get a new computer every 4 or 5 years because, obviously it gets out of date. And TCU is not increasing their capital. They're trying to keep it in the same place. They're trying to replace something that is out of date. So, or when an air conditioner breaks and we have to go replace that, we're not adding new capital. We're just replacing the existing capital. Capital wears out. The gap there is just to replace worn out capital. And as you'll see, sometimes we won't bother to replace it all. Sometimes we'll let stuff wear out. You know what? That air conditioner broke down and we ain't got the money. We're just going to shut that dorm down for a while. All right. So we don't think that it's worth the money. Now let's put it all together. Current stock of capital, entrepreneurial valuation of a single unit of the existing stock of capital. In other words, what they're willing to pay for an existing stock of capital, and there's that equation again. There is the possibility of building new capital. And here is that second demand curve, which now we have the total demand curve. This initial demand curve here was just thinking about, okay, sort of a static sense of if I could buy an existing restaurant right now. Wait a minute. But not only might I buy an existing restaurant or build a new one, I got to repair my old ones, all right? My old restaurants have to have things need to be replaced. So that's what that gap is right there. So now this is the total supply, existing plus new potential, and this is the total demand, the demand for the sort of basic demand for capital, and then also including replacing worn out capital. Voila, there's the cost to produce. This is how busy construction companies actually will be. And notice the construction company doesn't draw a distinction between whether or not they're building a new building or repairing an old one. It doesn't make any difference to them. The cost is the cost. So this lowercase d also adds, pardon me, to how busy the construction company is. Here's what the entrepreneurs were willing to pay at P sub S. That was his spot price and his flow price. I don't know why he called it that. He also said this, that's the demand price, this is the supply price. This is the price at which they can actually buy it. That's what they're willing to pay. That's what they have to pay. That's what the construction companies are telling them. Yeah, if you want this much activity, this is the price. And notice that what they're willing to pay is above what they have to pay. Yes, they're excited. So what we get is a total amount of new investment, this gap here, K sub 1 to K sub 3. That is, you remember we were at K sub 1, and then the total amount of investment for this time period is K sub 1 to K sub 3. But, so that's how busy construction companies are. In terms of the vertical intercept of the ZD diagram, if we abstract away from the government and trade and have just investment, that's how big the vertical intercept is. That was investment this time period. Now, something that the ZD diagram doesn't care about is how much of that investment was to build a new restaurant and how much of it was to repair an old one. But in this graph, we do care. This much was net. This much was brand new. This much was replacement. How do I know that? Because it's the gap between the two curves. I already said that's what that was. The gap between the two curves is just stuff that wore out. So of that total, let me even, well, nah, that's good. No, hang on, let me have a look here and see if I can zoom in a little bit more even. Yeah, it's a lot better. All right. Now that it's getting a little tight in here, let me zoom in. You won't see me as much, but perhaps that's a blessing. So here is just replacement. So if this was gross investment, all investment activity added together, and this is replacement investment, this must be net. This much was the addition of brand new restaurants. All right. This was just to keep the old restaurants going. This was brand new restaurants. And so what that means is the next time period, that's what I love about this graph, it's dynamic. It is showing something, it's a snapshot with the implication of, yeah, but it's not going to stay like this, all right? You draw a supply and demand diagram, there's no reason to believe it's ever going to move, right? But with this, you're saying that, okay, I know where it is right now, but glancing at that, I can see, aha, next time period, the supply curve will be there. Let me do that again. Next time period, the entire supply curve, S sub k, is going to shift right, and of course, pull this S sub k, S plus S sub k along with it. And that's what I do right here. Watch what's going to happen. K sub 2 is suddenly going to become the new current stock of capital. All right? But then what happens next? Well, this red line here becomes the new current stock of capital. And I think that's all I do right there. Yeah. So what we have here is that over time, when we start with PS above PF, we're going to slowly start, pardon me, shifting right, however the amount of net investment was. The amount of net investment was. Ooh, I need to show you something else. I got it on a piece of paper over there, though. But anyway, so there's the situation that you have when you start with PS above PF, all right? And it's just going to keep shifting right. And there's something else important to conclude about that in just a moment. But I just thought of something else I wanted to show you. Let me grab my notes here. Because something I haven't shown you is, what's the situation when PF is above PS? And I have that right here. When, in other words, here it is. In other words, what happens when how much you have to pay is actually greater than what you're willing to pay? When how much you have to pay is greater than what you're willing to pay as an entrepreneur, considering the construction of physical capital. I'm afraid I don't have this on a graph, but I've got it right there. Look at that one right there. What you can see is, you can see that in this situation, PF, which is always going to be the intersection of the SK, DK, DK, all right? It's going to be the far right one, because that's what's actually going to be going on this time period. PS, or the demand price, is kind of in your head, all right? It's not written down somewhere. It is what you would be willing to pay. PF is written down on a sheet of paper. That's what the construction company told you it's going to cost that, all right? So PF is a real world number. PS is also a real world number in a sense, but it's in your head, okay? And so when the price you have to pay is greater than what you're willing to pay, look at the gap between DK plus DK, look at the gap between DK and DK plus DK. Notice that it's bigger than the gap from K1 to K3. In other words, firms aren't going to bother to even replace all the old capital. In fact, the economy is going to shrink, or I shouldn't say that way. The stock of capital is going to shrink. It's going to go from K sub 1 to K sub 2. We're actually going to have negative net investment. Now, we still have positive gross investment. Positive gross investment was K1 to K3. That's how much investment there was. But K1 to K3 was insufficient to replace all of the worn out capital. To replace all of the worn out capital, we would have had to have replaced K2 to K3. We only replaced a portion of that. Why? Because entrepreneurs didn't think that whatever this industry is, maybe people are well, like right now, people stopped going out. We're still in the middle of COVID right now when I'm videoing this. People aren't going out to eat. So not only am I not going to build a new restaurant, I'm letting old restaurants shut down. So the total quantity of restaurants is going to go from K1 in this time period and shrink back to K2 in the previous time period. And there, if you want to take a screenshot or whatever, or pause the video and jot that down, that there shows you all the relevant values for on the graph, so you have a reference of that. And since I showed you that, I might as well show you the one for where the stock of capital is. Here it is. The situation I just showed you on the PowerPoint. There's the one where not only do we replace, investment's going to be K1 to K3. That's total investment. That not only took care of replacing the worn out capital, which was K2 to K3, but it also added some capital, K1 to K2. So we had positive net investment. And why did this happen? Because what entrepreneurs were willing to pay was P sub S, but what they had to pay was P sub F. So they were willing to build new capital. And if you want to jot all that down right there, you can. Okay, back to the video. Alex, need to come downstairs? Okay. I didn't know if she wanted to. She's in witness protection, so she doesn't like to be videoed. All right, so one way or the other. That was all exam one stuff. In fact, I think I'm going to put this video and shift it over towards exam one as well, which you'll already know because I will have already done it. But what all that implies, here I am making fun of ISLM curves, but you don't get to. What all that implies is that if we start like this, as I did on the PowerPoint just now, and have the total stock of capital continue shifting right, K1 to K2, or here, let me back up and show it again. Notice what's happening here. I don't know if you can see it or not, and I will show it in a minute with another graph, but net investment is getting smaller and smaller and smaller, and the gap between PS and PF is getting smaller and smaller. We're working towards this point. We're working towards the point that entrepreneurs have built as many restaurants as they want. Right? They build as many as they want, and all they're doing from now on is simply replacement, nothing else. They've got as many restaurants as they want. They're only doing replacement investment now. This is a stationary state, right? So this happens regardless of whether we start with PS above PF or PF above PS. It eventually stops right here. And when as I said a minute ago, this really bothered me the first time I read the textbook, and I thought, well, that's not true. And Davidson just kind of left it right there. And I thought, well, he's leaving something out here. And so that's what I added. I added what he left out. That's going to be this. How do we actually get a business cycle? Why is it that that's not what really happens? Why is it that instead we get expansion, recession, expansion, recession? It is because the demand curve is going to keep shifting in a predictable manner. Not in a predictable manner in which you can say, oh, it's going to be next week, but in a predictable manner in that we know one of these axes is going to follow the other, is going to follow the other, is going to follow the other, in a predictable pattern, right? So remember the equation here for the demand curve, and think in particular about the expected growth in demand for the products produced by the capital in question. All right. Actually, I think it'll be easier to show you as we go along here. And remember the previous video that you would have just watched in this about uncertainty. Remember that uncertainty creates a decision-making environment in which you can have panic, euphoria, where animal spirits are absolutely necessary to push people over the top in making decisions. And so therefore, surprises, outcomes you did not expect, can impact people in much more significant ways than they would if it was an environment of risk. And risk, of course, is when you know all the possible futures, you just don't know which one's going to come up. Let's say you're playing a game where you roll 2 dice and you're trying to guess the outcome. Well, by far the most common, well, I shouldn't say by far. The most common outcome of rolling 2 dice is a 7, right? It is the most common result. What if you rolled a 3? Oh my God, I never expected a 3. Well, no, a 3 is unlikely. But rolling a 3 does not then make you think, oh my gosh, my entire evaluation of the, now he's cleaning me, thank you, Doug. My entire evaluation of the way the probability tables worked was off. No, I still know they were right. It's like you're playing poker and you didn't get the card you wanted and you lost. Well, that's why they call it gambling. But it doesn't make you think, wow, maybe the odds of getting an ace were different than I expected. No, the odds of getting an ace were one out of, out of however many aces were left in terms of the size of the deck and what card. Oh, I'm sorry, now I'm getting complicated. But, in a 52 card deck, there are 4 aces, right? And that doesn't change. In a world of uncertainty, you're never quite sure what the underlying odds are. And that's the problem. You do stop and think, well, crap, maybe there aren't as many aces as I thought there were. Stop investing. Or when things are going well, there's a freaking ace in every hand. I just need to keep investing. So we get this volatile behavior from an environment of uncertainty. Okay, so how does that translate into a business cycle? And here's just a summary to start with. And I got the business cycle split into 4 stages. Early expansion, mid-expansion, late expansion, and then of course the recession. Early expansion, investors' expectations tend to be kind of tentative. They're just coming out of the recession, so they're still a little nervous. And investment spending is moderate, but profits tend to be better than expected in this period. There is no period of all these, I've done a lot of statistical analyses of this. Of all these 4 periods here, the period during which the rate of increase of profit is the highest is unquestionably this one. Now, part of that is because profits really sucked down here, right? And then when you got to early expansion, there was a big jump. But that doesn't make any difference. You weren't necessarily expecting it yet. And you're thinking, wow, this is great. So whenever you don't get as expected, it causes a shift in your expectations and therefore a shift in the demand curve that I've been drawing on that diagram. Things were better than expected. Wham, push the demand curve out to the right. It's like, wow, I've reevaluated my chances of making a profit from this investment and I think things look really good. I got things that were better than expected. And so I'm somewhat euphoric right now, right? Then in mid-expansion, what tends to happen is investment's booming, people are optimistic, and they make the profits they expected to make. All right, so there is no shift of any sort there. There is no shift of the demand curve in mid-expansion because people got what they expected. It's only when they get a surprise that they shift right or left. A positive surprise is better than you expected, shifts it right. Negative surprise, shifts it left. But then in late expansion, and do I have that on here? No, I don't. In late expansion, a number of things combine. One is you've been building restaurants for a while, and you know that the market is not going to support an infinite number of restaurants. You probably had a target set for yourself. Okay, we're going to get 3 new franchises over the next 3 years, and then we'll see how things are. But if things don't change, we'll stick to that. So you already weren't going to build restaurants forever, because nobody makes money building a restaurant. You make money opening the restaurant. All right, well, that's not true. The construction company made money, but you know what I mean. The entrepreneur who is deciding whether or not to build a restaurant doesn't make any money from building it. They only make money when they open the doors. Second, they're in a lot of debt now, all right? That they've taken on debt to build all these things, and so not only are they not as creditworthy as they were once before, but also they don't want to borrow any more money. And so they excitedly open their doors in late expansion. But because people are slowing down investment, that means the economy has lowered incomes, which means that they don't sell what they expected. They don't sell what they expected here because they had slowed investment spending, but they hadn't really slowed the expectations at the same amount. They do tend to slow somewhat, but they're still very positive at this point. And so they're disappointed, all right? And what happens? You're disappointed, the whole thing shifts to the left. And then you get a collapse in the economy down to the recession. And in the recession, you're pessimistic and things really do suck, so it doesn't shift. So the 2 shifting points are here and here. This shifts the demand curve right, this shifts the demand curve left. By the way, there are, of course, restaurateurs who open their restaurants during mid-expansion and are not disappointed at all. Things are great for them. But the people that don't open until late, they base their forecast of sales on what was happening in here. And they didn't get that because investment had slowed down. And so this disappoints them, and we have a leftward shift in the demand curve. All right, so here's how we're going to show that. Okay? And what I did was I put a little scale down here at the bottom so we could keep track of some sizes. He's heading away. Oh, no, I see. He's just looking at the graph. Good for you. What I did was I put some numbers down there so we keep track of it. And I just made up some numbers here, right? Here's investment in early expansion. It's 6.5 units, all right? So remember that K1 to K3 is going to be total investment. K1 to K2 is net, and K2 to K3 is replacement. But of course, the economy doesn't care whether it's replacement or net. This created jobs. The whole thing created jobs. So 6.5%, 6.5 units, whatever this is, $1 trillion, whatever. That much investment took place, and it was unexpected. So, now notice two things happen here. The supply curves shift to the right. They're going to do that because there was positive net investment. Positive net investment up to K2. So watch carefully. We're now over top of K2. See that the SK moved over top of K2. There's the old K1. So in other circumstances, the rightward shift would actually have caused investment to shrink. But the demand curves, and I'm showing where the old ones were here with the dashed lines, the demand curves jumped so far out to the right because of the euphoria, the positive result of the fact that, hey, I didn't expect it to be this good. This is awesome. And so we end up with investment rising even more. So here we are in mid-expansion. Mid-expansion. These are going along great. So, but the problem is that there is no surprise in mid-expansion. This is what they expected. So, by late expansion, the demand curves are still going to be right there, right? They're not going to move. Now, what I said in the chart was they may moderate somewhat, so maybe they'll come in a little bit, but they're not going to move to the right anymore. They're done moving to the right, which means that the rightward shift in SK, which is going to go here now to K4, is just going to shrink investment. Watch what happens. Demand curves did not move, but supply curves still did, because now the SK, the vertical line, is going to have to be over top of K4. And there it is, over top of K4. Now look how small investment gets then. Now investment is actually still higher than it was in early investment, in early expansion. And Keynes makes this point in the general theory. He says, it's not like they made bad money. It's just less than they expected. And when they put themselves on the line like they did, investment is a very long-term commitment. It is practically irreversible. And it's very expensive. They really put their reputations on the line. They were still expecting 8.5. Now again, this is investment, but investment is of course creating income, and the income is creating profits. And actually, as we'll see later, there's an extremely high correlation between investment and profits, investment that takes place and profits that are subsequently generated. But that'll have to wait till Koleski, another economist, we cover. So 7 is not bad. It's better than it was in early. And remember, they were excited in early, but it's not what they expected. They were figuring things to stay around 8 still, right? So now they're like, oh crap, we're really upset. And now check out what happens. Of course, we're still having positive net investment here in late expansion. It's just a lot smaller. And we're going to go from K4 to K6 in terms of the vertical supply curve. But we're not only going to do that, which is going to lower investment, because always when the supply curves move right, it means that we've caught up to how many restaurants we want. Next time period, we aren't going to build as many. Not only that, but the demand curves will shift left. And I made this a really tiny one here, 2. We end up with investment being 2. And actually, if you look at this closely, what you're going to see is that next time period, investment's going to drop back, or the stock of capital is going to drop back to here. They're actually shutting restaurants down during the recession, which makes perfect sense, of course. We're not even covering all of the replacement investment. We're actually shutting restaurants down. So, this is what is theoretically happening here. I showed this when I did the presentation. I'm not even sure if I showed it. I think I decided that it wasn't worth the time. Yes, doggy. This is where I went through and calculated some data for it. And what I want to show you is, in particular, how, now these are deflated corporate profits. That's what I had data for, corporate profits. Corporate profits tend to increase by 20% in early expansion. And I think I counted that as the first year of expansion. I know I counted late expansion as the last. The National Bureau of Economic Research decides when there was an expansion or recession. I don't do that. So I took their dates, and I took the last year of their expansion as being late expansion. And I think the first year, I had to go back and read the paper again. And then whatever was left over as mid-expansion. And they defined recession. And in early expansion, look how much profits tended to jump up. This is why people are so excited. And this over here is derivative of something called the Purchasing Managers Index. So I think I made you do something with that in the statistical part of the class early on. Can you see that very clearly? Let me have a look here. Sometimes the camera ends up focusing on me because that's what it tries to do. I'll sit back over here and I'll scooch it in. Oh, okay. What I did just now was I pulled the HDMI cable out of the camera so I can't see what I'm videoing now. But there, it's plugged back in. Okay. And yeah, okay, that's good. All right, so this is derivative of something called the Purchasing Managers Index, and I won't go into detail on how I calculated that, but what it is it's a measure of how excited they were about the future. And a zero would have been like we think things are going to stay the same. Well, this is not much different than a zero, and yet look what profits did. Huge excitement. They shifted demand curves to the right. Second period, they're really excited. They think things are really going to get better, and profits go up by 10%. And don't forget, 10% on top of the 20, all right? And this is 10% per year. It's probably going to be about an average of 4-year period right here. Yeah, about a 4-year period. But then, now notice that they did temper their expectations in late expansion in the last year, but they're still expecting these to get better, because zero is average, all right? And yet, profits actually fell. Now, if you think about it, they fell, yeah, but after like 4 or 5 years of going up. So, but they didn't expect it. And this is what causes the shock. And then look at the negative 1.72 down here. They really expect things to be really bad during the recession. And they're right. That's the worst period of all. All right, so that's kind of the empirical evidence for that. Let's see. I think that, yeah, clearly that's everything because that's the end of the video. All right. So that is how you use Davidson's capital market to explain a business cycle. And remember that whenever investment rises and falls, it's going to cause that, just as I showed a minute ago but decided not to go through it, it's going to cause the intercept of the ZD diagram to go up and down, and therefore it's going to cause employment to go up and down. So what's going on that capital market diagram is directly driving employment.